There is a trading operation moving billions of dollars through the financial system every single day. They don't give CEO interviews, they don't post on social media, they avoid public attention entirely. Their influence comes from recognizing a specific, repeating pattern in the market. Human beings react exactly the same way under pressure. When most people picture Wall Street, they still imagine traders screaming over each other on the exchange floor. But that physical chaos has been replaced by quiet data centers. The actual trading happens through automated algorithms and supercomputers, executing decisions faster than a human brain can even process a thought. While everyday investors are busy drawing lines on price charts, these operations are mapping out human behavior itself, and that creates a massive gap in who controls the outcome. We're taught that markets move because a company releases a good earnings report, or the Federal Reserve changes interest rates. But institutional systems operate on a different premise. Markets move because of fear, greed, and panic. This probability curve is the result of thousands of chaotic inputs: news headlines, social media posts, trading volume, being filtered and condensed into a single predictive output. To build these models, the most successful firms stopped hiring traditional finance graduates a long time ago. They hire mathematicians, physicists, coders, and artificial intelligence researchers. These teams aren't trying to guess what the stock market will do tomorrow. They are simply calculating the highest probability of how a crowd will react to a specific stimulus over the next few seconds. They win by systematically applying strict mathematics to biological human weaknesses. But predicting human behavior only works if you can execute the trade before anyone else. In modern finance, a single millisecond is worth billions of dollars. Firms spend massive amounts of capital constructing entire buildings filled with highly optimized servers positioned physically close to the actual stock exchange. They lay dedicated, specialized fiber optic cables straight to the exchanges. By the time an average investor reads a breaking headline on a financial website, these systems have already executed thousands of individual trades based on that exact news. You might wake up, look at your phone, and see your portfolio dropping in pre-market trading. The algorithms already processed that information, traded the panic, and extracted their profit hours before you even unlocked your screen. The market has evolved into an environment where human biology simply cannot compete on the same timeline as physical hardware. Even with endless rows of supercomputers, the entire system relies on exploiting predictable human actions. People buy when everyone is buying, they panic when they see red, and they chase whatever is trending. This creates a direct mechanism for wealth transfer. The impatient, emotional capital of retail investors essentially serves as the liquidity for these patient, systematic machines. This network maps how that acceleration happens today. Thousands of sentiment nodes from social feeds and financial news are ingested by an artificial intelligence model, which instantly translates that text into mechanical buy and sell signals. As machine learning models ingest more historical data, their ability to predict exactly when a retail crowd will fold or double down becomes incredibly precise, which forces us to ask a very uncomfortable question. If software is statistically superior at executing trades, what happens to the individual holding a brokerage account? Wall Street is becoming a closed, automated loop dominated entirely by code. The natural reaction to this is to assume the individual has no chance. But most everyday investors only lose money because they willingly try to play the machines at their own short-term game. Trying to day trade against a billion-dollar server farm is like racing a bicycle against a Formula One engine. You aren't just outmatched, you are playing a game governed by physics you cannot influence. The only mathematical solution for an individual is to change the parameters of the game entirely. That means focusing on long-term ownership, actual patience, and strict emotional control. Algorithms dictate what happens in the microseconds and the daily price swings, but extending your timeline outward removes their speed advantage completely, and wealth still flows to human discipline over years and decades. The second-by-second fluctuations of the market are now the domain of high-speed execution systems, but those who recognize this early and refuse to step into the short-term trap hold on to the actual leverage. If you want to understand money, market psychology, and the hidden systems controlling modern finance, subscribe to Streets, the people who understand the mechanics